A very good morning to all of you students. My name is Devas Gupta and today we will be discussing on the topic of securitization. So yeah, let's start. So to understand securitization, let's first try to understand some of the situations which has led to the innovation to this innovative concept of securitization. So let's assume that there is a home loan taken by some person, let's say Mr. A. And since we talk about home loan, generally these they will be taking it from the bank. There are other institutions also. So let's in our example, let's take an example that Mr. A is taking a home loan from bank. So bank will provide money to Mr. A, right, in the form of a loan given to Mr. A. And what will Mr. A do? Mr. A will provide the commitment to bank to repay the principal and interest, right? So it's actually the commitment to repay the interest, repay the principal as well as interest, right? And generally, we understand that the term of these loans are, very big, right? It's not for 1 year, 2 year, or 3 year. The money of bank gets blocked in this loan for almost, let's say, more than 15 years. So in this example, that this is a
Devasji, I think your voice is breaking.
home loan.
Devasji,
Yes, yes, sir.
I think your voice is quite breaking.
Okay, okay. Is it better now, sir?
Now it's better. Please repeat the concept again.
Sure, sir. Sure, sir. I will do the repeat. Yeah. So yeah, let me repeat whatever we have covered till now. So I started with an example that Mr. A has taken a loan from bank, and that is a home loan, and Mr. A in turn is giving commitment to repay the principal as well as interest to the bank. And as we know that since these are home loans, the tenure of such loans is higher. So we have taken a 25 years kind of a tenure for the repayment of the loan, right? So this is the background. Now essentially what happens if you understand from the bank's point of view, right? So depositors actually deposit money into the bank, right? Like general people who will deposit into their savings account, into their FD account, right? So those becomes liabilities of the bank, correct? Because bank has accepted those deposits. Now using those deposits, bank will lend money in form of loans, right? And these becomes their assets. Ultimately what happens, whatever interest bank earns on this loans, right, here the interest is earned and here the interest is paid. So whatever is the difference between these two becomes the net interest income for the bank, right? Interest earned is, let's say, at the rate of 9%, and interest paid is, let's say, at the rate of 8%. So this difference of 9 minus 8, which is equal to 1%, becomes the income for the bank. Now, in the above example, if you see, the bank's earning potential is only limited to the amount of the loan that bank has given to Mr. A, right? Beyond that, bank cannot earn, correct? So the bank's earning potential gets limited in such a scenario. because the depositor's money, whatever, let's say, let's assume that it was deposited as 10 crore and entire 10 crore is given as a loan. Although I am keeping aside the requirement of CRR, SLR, that is separate. As of now, let's assume that all the amount is given as a loan. So whatever bank can earn is only up to the extent of 10 crore. So this is the problem with the bank. Now, to overcome this limited earning potential, or let's say limited banking, solution, what bank, what other options are available with bank so that bank can expand more, right? Because higher lending bank will give, better it will be for the bank because the interest will keep on coming. So I request all of you, if you can, put down your thoughts either in the chat box or in the query handle, that what all options are available with the bank so that the book value of the loan increases or bank has more funds to lend it. There are multiple options available. You can think of anything from your practical experience or from your previous understanding. Yeah. So you can put it in your query handle or in the chat box. What all are the other options that bank can adopt to expand its loans portfolio? To borrow from other bank, yes, very good. What this bank can do, bank can further borrow from other banks. So Abrikesh has mentioned that. Any other thought or any other idea? Sell the loans at lower rate. Yes, I think there is one response that we got. Hemant is saying sell the loans at lower rate. Yes, we will come to this. SPVs from RBI, okay, no worries. So let me pick this up from Hemant. Sell the loans at lower rate. So there are two ways, as you know, both the options came in the discussion. Yeah, so to issue deposits to bank, which will again become the asset for the bank, right? Yes, yes, special purpose vehicle. We will come to that, Karthik. Yes. Now, so I think broadly there are only two ways. Either you increase your liabilities. By liabilities, I mean even equity also, equity or liability, so that you are having sufficient corpus, right? You are having higher amount of corpus, which can again lead to higher amount of assets, right? So this is option number one. Now, how can you increase your liabilities or equity? By further asking for the equity or by further borrowing from the other banks, right? That's how you can do. But what are the disadvantages of that? So I think this is a very plain vanilla option available with the banks. But why bank will not want to do it? Because does anyone want to attempt this? Why will bank will have second priority in terms of borrowing? Because it will increase the, yes, I think some of the responses are coming. All are on demand, yes. Because tomorrow what will happen? The people will come and ask for the money, and then bank might not have sufficient funds. Cost will also increase. Repayable, yes. Perfect. Now, the one more problem in addition to all of this is the financial risk, right? Because we have studied earlier that higher you borrow, higher your financial risk is, right? Because with the borrowing, the repayment capability also needs to be established. If you don't have a repayment capability, then you are under a financial risk of not being able to repay the loan back, right? So the risk becomes higher. with the higher amount of borrowing. Now, what solution has been devised in such a case is just keeping your deposits or liabilities at a same level. Can we look into selling these assets, right? Can we look into selling these assets? And can I call these assets as illiquid assets? Can I call these assets as illiquid assets? Why? Because as I mentioned earlier, the tenure of such loans is almost 25 years, right? It's for a higher amount of time period, which will imply that today, if I want to realize these assets, I cannot realize them, right? Hence, I'm saying as of now, these assets are illiquid for the bank because there is no liquidity attached to such assets. Clear? So, what I'm trying to do over here is I'm trying to sell the illiquid assets. I will come to this that whom it will be sold, right? We will come to that. There is a complete discussion on securitization. Now, as of now, let's say that once I sell the liquid assets, I will, the bank will realize some cash, realize, let's say, funds. After realizing such funds, the bank will again be able to lend or give a loan of those funds, right? So now if you see, the loan book value will increase for the bank multifold for the same level of liability. So liability remains same and the asset base will keep on increasing. Clear? Or let's say the loan book value will keep on increasing. Why? Because the bank is going to sell the liquid assets, realize funds, again it will give the loan, again it will sell that loan, realize funds and give. Now in this entire thing, right, the bank is not going to make enormous money also, right? Because whenever you are selling the asset, you're also the entire, hello, sorry, I think there was some network issue at my end. Am I audible now? Okay, 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 sure. Yes. Yeah, so what I was saying is that because of such process of selling the illiquid assets, realizing the funds and again lending such funds will increase the earning capability of the bank, but it, but to a limited extent, right? Because the moment you sell the asset, you are also giving up the right to receive interest on that, correct? So yeah, so this is the process, this is the first leg of securitization where the bank is going to sell the assets, right? Now in the above example, we have taken home loan, right, as the underlying. There can be other types of loans as well. For example, auto loan, automobile loan. Again, let's say Mr. A is taking automobile loan, right? And again, Mr. A will give the commitment to repay principal plus interest. Okay, so there can be any kind of receivable standing in the books of bank, whether it is a automobile loan or whether it is a home loan, right? Which has more or less similar kind of, let's say, characteristics. Okay, one more drawback. So we were discussing about some of the drawbacks in case the banks increases their liability base, right? One more drawback, one was the financial risk increase, second one was the debt equity ratio will also be a problem, right? Because the debt equity ratio will also increase, which will again imply that the financial KPIs are not good. Okay, yeah. So till now, are we clear? Are there any queries which you have? I'm just checking the chat. Okay, not yet. Perfect. I'm just checking both the query handles as well. Okay, perfect. So let's move on then. So if I ask you, what is loan actually? So if you think it from that perspective, loan is what? Loan is something called as a commitment, right? If I have taken a loan, I am committing myself, right? And the person who has given a loan, that person is having a right to receive interest and principal, right? So can I say that loan is actually right to receive interest and principal, right? Correct. And some of you might know that housing loan is also called as mortgage loan, right? Why it is called as mortgage loan? Can anyone tell me why generally mortgage loan is called as housing loan? Yes, because house is mortgaged. Because while giving the loan, the bank accepts house as a security and it is mortgaged with the bank for lending the loan. Yes, their house is mortgaged to the bank. Sorry, just a second. Now, the moment, so there is a relevance of this term. Okay, I will tell you later on. But as of now, let's keep in mind that housing loans are generally called as mortgage loans, which is fine. Then, now let's come to the securitization model. Okay. Now let's take an example of again Mr. A who has taken the loan. Similar to Mr. A, there will be, let's say, thousands of borrowers, right? These are thousands of borrowers who have taken money on loan from the bank to purchase a, yes, Abrikesh, nowadays it is mandatory the house to be, and let's take this bank which has given such loan. Okay. So what I'm saying is there are thousands of borrowers like Mr. A who has taken retail loan from the bank, right? Retail home loan from the bank. And these thousands of borrowers, let's say in totality, have taken an amount of, let's say, 1,000 crore. I'm just taking for an example just to build it in the case study. And Mr. A, along with these 1,000 borrowers independently, have given the confirmation of repayment plus interest mortgage loan, right? Clear? So the bank has given mortgage loans to Mr. A, like 1,000 people, and Mr. A has given a commitment to the bank to repay it. And we call these as illiquid assets, as we mentioned above, right? All these are illiquid assets from the point of view of bank, because bank is not going to get any liquidity out of it. So as I said that this 1,000 crores is being lended, and let's assume that this is lended for 20 years to all these different people, right? Now what bank will do? So there will be an SPV, special purpose vehicle. Okay. So now this special purpose vehicle, who will create, how it will get created, we will go on to that discussion later on. But there will be a third party apart from the bank and these borrowers, whose responsibility will be, or let's say whose role in the entire securitization will be to purchase these assets from the bank and to pay the amount to the bank for such purchase. Okay. So now what will bank do? Bank will actually transfer the right to receive principal plus interest both. Correct? As I mentioned, that loan is nothing but a right. So they will be also transferring the right to receive the principal and interest, or in layman words, it will be transferring the loan to SPV. Okay. And what SPV will do? SPV will pay to the bank this 1,000 crores back. Pay 1,000 crore to bank. Clear? So this special purpose vehicle, let me just special purpose vehicle. Now this SPV, the term can be used in different context, right? So any entity which has been created for some specific purpose is called as SPV. For example, an airport has to be built. For that, a SPV is created so that once the airport is built, the purpose of that entity is over. Similarly, if securitization has to be done, so this entity will have a special purpose to accept the loans from bank, pay it back to the bank, right? So for that specific purpose, this SPV will be created. Now, can anyone tell me from where this SPV will get the funds? Because while SPV has paid to the bank, from where the SPV will be obtaining the funds? What are the sources through which SPV can arrange the funds? Yes, Abrikesh is saying investors, equity or borrowing. Karthik is saying equity or borrowing. Anything else? Yes, Hemant. They will yeah. Any more thoughts? I request who all are there. Yes. Oja Ginny is saying mutual funds. It's yeah. So basically, the mutual funds will also be one of the type of the investors that we will study now. I think yeah. Perfect. So now what will happen? Now this SPV will not go into the conventional model of directly taking amount again from the bank, because the moment it happens, another just a second. Am I audible?
So now it's audible, but intermittently it got break. Maybe network issue or
Okay, okay. Just let me know whether now it is audible.
yes,
Okay, I think there is some serious problem at my end only. Uh, yeah, let me just see if it continues. Let me have some workaround on this. But yeah, I mean, I'm just repeating it a very slow pace, and hence because this topic is itself, um, yeah. So what I was saying is, for example, now this SPV will have borrowings, can get the funds in terms of borrowings, or also it can get the funds via some capital infusion, right? These are the two main options. Now, what I was saying, if it borrows from another bank, right? Then ultimately, what is happening? Bank is giving to SPV, and SPV is again giving back to this bank, correct? Which will again form a circle, which we would want to avoid, correct? Hence, this SPV might not borrow, is what we are saying, right? Because again, then one bank, it is as good as one bank giving funds to another bank. Now the way it will resort to is, this SPV has already got this pool of funds, right? This 1,000 crore is actually pool of funds, right? So this pool of funds, it will go and see that what are the characteristics by when the repayment will happen, what is the rate of interest, what is the risk profile of such loans that has been given. So what this SPV will do, SPV will go beyond this 1,000 crore and see what is the correct underlying for the pool of funds, and accordingly it will break down this pool of funds into different strips, right? So let's say this 1,000 crore can be broken down basis its assessment into 1,000 units at the rate 1 crore each. So this is the function of SPV. Okay, that SPV we will be able to assess and determine it. And what it will do now, it will sell these 1,000 units to the regular investors, right? So it will issue securities. Why do we call them securities? So why do we call them securities? Because just like an equity instrument or just like a bond, this is another kind of security which a SPV is issuing to the different class of investors. Now there will be 1,000 units, and the type of investors will be some sort of pension funds, which have huge amount of money, then mutual funds, right? Then let's say other type of banks, right? Some of the banks also can participate here as an investor, okay? But the risk is very low here. I'll explain how. Then some sort of institutional investors. These institutional investors are such investors who have big amount of money that can be invested, right? So you see all these investors are having large amount of money, they deal in large amount of funds being managed, and hence they can decide to purchase some of the units issued by such SPVs, and this makes the process of issuing the securities back to the investors as the last leg of securitization. Okay, now as I was saying that the risk will become very low in case of such securities. How? If you imagine entire 1,000 crore being purchased by one investor, or entire 1,000 crore being purchased by hundreds of investors, right? So the concentration risk is very low now, right? So what we are doing is, instead of asking one investor to invest in SPV and hence in that loan, we are asking many investors to do that. That is point number one. Point number two, the benefit of this entire part is that, let's say Mr. A, like these 1,000 people or borrowers, they are supposed to pay 10% of interest, right? Now the bank will keep 1% with it, and let's say 9% will go to SPV. Okay, because let's say the bank has taken the initial efforts to get this loan, or let's say to advance this loan, right? Hence 1% is what bank will keep, and bank will say to SPV, okay, I can give you 9%. Now this SPV will also have some funds, or let's say will also bear some costs, right? Because it is running a books. So that cost, let's say SPV says that, okay, I will make, let's say 0.5% of the entire loan book value. Balance 8.5% will be passed on to the investors. Is this point clear? I hope this is clear. So, in a way, some of these factors will also lead to how the margins, or let's say how the cost will be shared amongst all the participants in the chain, right? Now if I may summarize everything into this. Yes, Oja is asking, Oja Jin is asking, sir, this 0.5% is commission for SPV. Yes, this is a commission for SPV, and from this commission, SPV is supposed to incur its own costs, right? No, this you are saying 0.5 is a very low margin. I am saying 0.5 is a, let's say, decent margin, because see, the role of SPV is what? The role of SPV is not to get the, I mean, is not to do the security profile check of thousands of such investors, or let's say to scrutinize the documents before giving a loan. So all those efforts already bank has done. SPV has just brought together the investors, it has issued securities to the investors, and It has purchased those assets from the bank. So SPV, although it has a good amount of role to play, this margin can vary, let's say 0.5 to 1% also, but it again depends, right? The quality of the loan also, or let's say whatever different administrative costs incurred by the SPV as well, right? So higher or lower will depend really on the kind of efforts this SPV is doing. Plus, it will also depend on whether this is a recourse or non-recourse basis arrangement, which we will come to it later, okay? Which we will also cover. In the recourse and non-recourse, the pricing may be different. Clear, students, till now? Now, what I'm saying is, just to summarize this, illiquid assets which is what, let's say, pool of funds slash loan. I can say loans, right? Which loans? Mortgage loans. Okay, Mamta, I will explain. So illiquid assets, which I can say pool of funds or loans, in a way I'm saying these are mortgage loans, right? So the process of converting such illiquid assets into securities which are marketable. Why marketable? I'm saying because tomorrow, in case these investors wants to sell this security to realize immediate cash, they can do that. So what they will do, let's say pension fund can sell this security, right? Hence it is called as marketable securities. Marketable means which can be easily put up for sale in the market. So ultimately what has happened, the illiquid assets of 1000 crore has got converted into marketable securities of, let's say, 1000 units at the rate 1 crore each. So this process is called as securitization. So this process is called as securitization, right? Because what has happened here, with the help of SPV, with the help of investors, with the help of bank, they are able to come to an arrangement where the illiquid assets held by the bank are now converted into marketable securities ultimately, which investors hold, which can be sold into the market. So the liquidity has again come back to the, let's say, come back to this system. Correct? Yes. So now Mamta was asking, please brief again about 1%. So what I'm saying is, let me just use the other color. So this, I told you that let's assume that this 10% is the interest that Mr. A and other 1000 borrowers are supposed to give it to the bank, right? Are supposed to give it to the bank. Now, bank will not pay entire 10% to the SPV. Why there is a need from bank to pay to SPV? Because SPV has purchased the loan, correct? So ultimately now SPV will be entitled. Yeah. So I'm saying that SPV will be entitled to receive the interest from bank, right? Now, bank will not pay entire 10%. Bank will keep some amount for the bank itself and will pay only 9%. Again, I am just taking an example. It can be zero point 0.5, it can be 1, it can be 1.5, depending on lot of other factors, right? Depending on the demand and supply of the loan, of the credit also, right? Depending on the percentage that is appearing in the, depending on the interest rates that are appearing in the market, right? There are a lot of things. So this bank will pay to SPV at the rate of 9%, and 1% bank will keep it with itself. Now this SPV will also have some costs to be managed, right? Now this SPV also will not pay entire 9% back to the investors. Investors, let's say, will only get 8.5% as a return on the amount that they've invested. 0.5% will be kept by SPV to manage the day-to-day costs. So Mamta, this is what we have discussed and explained earlier. Okay? Okay, perfect. Now, can anyone tell me? Yes, Hemant, we do have such SPVs in India. There are many SPVs who are working on the securitization model. And all of you will remember, sorry, in uh, yeah, sorry. So what I was saying is, yes, there are these kind of SPVs that exists in India, and there was a special act also, Sarfaces Act, if you would remember, right? Securitization and reconstruction of financial asset and enforcement. Yeah, because these are marketable securities, that's why. Okay, Heman. Yeah, so let's move on. What I'm saying is that these marketable securities are also called as MBS. Can anyone guess what is the full form of this MBS? I covered one topic above.
Mortgage-backed securities, sir.
Very good, Nisha. Yes. So these are called as mortgage-backed securities. Yes, Hemant. Very good. Backed or based, whatever we want to say, and securities, right? Now, why do we call them mortgage-backed securities? That is the point to understand, because the underlying of MBS is what? The mortgage loan. See, ultimately, these securities are issued with the underlying performance of these mortgage loans, right? Correct. Now, these mortgage loans are home loans as we discussed. Then what will be other type of loans will be called as? Let's say I'm talking about automobile loan. So automobile loans, what will be the securitized marketable security which is issued here will be called as? I can say other receivables also, in case other receivables are also securitized. These are called as, let me put it, asset-backed securities. Or again, based, whatever you want to say, securities. So this is called as ABS. This is called as MBS, right? So generally, mortgage-backed securities will have underlying as a mortgage loan, asset-backed security, which is having an underlying of, let's say, automobile loans or any other receivables or even credit card receivable as the underlying, right? Clear? Yeah. Now let's come to some of the technical terms, students. Okay. So I will keep the placement very similar to what we discussed. Okay. So the person who takes the loan is called as a borrower, right? I'm taking all the borrowers at one go now. Okay. The originate, so the bank here is called as originator. This is the technical term used in the study material as well as in the securitization process. Okay. So the borrower is similar to Mr. A who has borrowed the loan. Bank is called as originator. Why? Because they are originator of the loan. They have initiated the loan, right? And SPV is called as SPV only here. Then there are investors. Okay, let me put investors a bit down so that we can explain other concept here. Okay. So these are investors. Okay, so Abrikesh is asking how credit cards are ABS. Okay, let me explain. What happens, just like loan, credit cards also is a asset for the company who has issued such credit cards, right? If let's say uh, there is a separate company or there is a separate NBFC who has issued credit card, whatever amount they are holding in terms of the credit card is a receivable to them, right? Because they are supposed to receive it from the credit card holder. Credit card holder has already used that amount. Now, with them also, there is an option to do the securitization of such credit card receivables. So, just like this process that we discussed above, they will be selling those receivables to an SPV, and this SPV will be securitizing it, issuing different securities, marketable securities for such credit card receivable. And hence, for that other receivable or credit card receivable, we call it as a asset backed security. Okay. So these are just some of the terms. Let's say while you will be going through the study material or understanding securitization process. So these are the commonly used terms: mortgage-backed securities and asset-backed securities that we use. Okay. Yes, credit cards are very short term. Now, the purpose of securitization, doing the securitization of this credit card is something else, right? It is not to avoid the long term, let's say, illiquidity of the assets. Correct. These are something like that, right?
So there was some audio issue.
Hello.
सर वापस से रिपीट कर दीजिए ऑडियो इशू हो गया.
Yes, Sumit. Yeah. So what I'm saying is that the credit card, we were on the credit card receivable, which I think Hemant had asked it. Yes, the credit cards are very short term. I was saying yes, credit cards are short term, and the securitization can happen for short term assets as well, right? Because the purpose of securitization over there is to again get more funds. And see what will happen now, these credit card receivables might become illiquid at some point of time. So again, to convert such illiquid assets into the marketable securities, that will become the purpose of converting the credit cards into securitization. Okay. Yeah. Now what I'm saying is, let's come to this discussion where these are the technical terms. Yes. So I will start the discussion now. So there are two ways an originator can transfer the loan to SPV. One is on a recourse basis. Second one is a non-recourse basis. Okay. Now the recourse basis is, as the name suggests, is the process in which tomorrow, if there is a default that happens from the borrower side, SPV can come back and ask originator to make good that default. Okay, I'm just repeating that under recourse basis, it will allow SPV to get funds from originator in case borrower defaults. So in case a borrower is defaulting, the SPV can go back to the originator and ask for the funds. Okay. So do you think under recourse basis, okay, let me come to that question later. Let's first understand the non-recourse also. Then we will be able to draw the parallels between two. So under non-recourse basis, there is no entitlement to the SPV to get funds back from originator. Clear? I think the distinction is very clear, because see, ultimately what can happen out of these 1,000 borrowers, can I say that 20%, of the borrower, there is a probability that they will default. Probability of default is 20%, and they will only be able to pay us back 50% of the amount. So 20% borrowers will only pay us 50% of the amount. That's the probability, right? So on 1000 crore into 20% into 50% will become our risk, the value at risk, right? Or let's say the value at which we are not being able to recover the amounts. So this will become 200 and 50%, 100 crores, right? So 100 crores is the amount which is at risk. Now this 100 crores, or let's say this entire arrangement, has two ways as we discussed. Let's say if these 100 crore is not recovered, is if borrower is not paying to the originator, then what originator can do? Then what SPV can do? SPV will have a recourse back to the originator, and it can ask that, okay, you give me that 100 crore because I have taken it on a recourse basis. On a non-recourse basis, SPV will have to bear the loss of 100 crore, right? Now, can anyone tell me how the pricing, or let's say how the SPV commission will change the moment we talk about recourse and non-recourse? Do you think under non-recourse, the SPV commission will be higher or lower? Yes, Abrikeji, it will be. I think I'm getting responses. Karthik, you're right. Mamta, you're right. Nisha, you're right. Very good. Oja, you're right. And Aburkeji, you are also right. So I think everyone is having the similar opinion. Under non-recourse, the commission will be higher because the risk of non-recoverability is with SPV, and hence the risk will be higher over here. Hemant is asking, what about the mortgage assets? SPV should be able to sell such assets. No, which assets you are talking about? SPV will not be selling the assets. Acha, you're talking about the non-recourse once this mortgage assets comes. Yes, they will be able to sell the assets. Hemant, yes, you're right. To realize this 100 crore again, because they are backed up by that mortgage, right? So till now clear, everyone. Should we move ahead? Recourse and non-recourse is clear. Perfect. Now let's move ahead. Let's introduce some of the other parties to the securitization process. Okay. So we discussed about borrowers. We discussed about originator. Now let's discuss about this SPV a bit in detail. Okay. Now this SPV is generally having yeah. So I'm saying that this, okay, I'm just repeating it. I know today there is a lot of issue at my end on the internet side. I will get it fixed, students. I apologize for that. So, what I was saying is that this SPV can be in the form of company, private company, or it can be in the form of partnership firm. But the best form it can be is in the form of a trust, right? It can be in the form of trust. So if it is a trust, then trustees will be there, right? Who will act as the decision making authority for the SPV. So they will be deciding that at what rate we have to purchase the loan from originator. What are the different sizes of the securities that we have to issue to the investors? Okay. So there are some trustees who are managing this SPV. Then finally, we said that there will be investors over here. Now, if you understand from the investor's perspective, so investors also will have lot of concerns while they will be going and buying such securities. They need some sort of, I would say, they need some sort of let's say guarantee that the securities that they are going to invest in are not going to give any false, or let's say tomorrow they are not going to be non recoverability in that, so that it does not become a loss to the investors. So that is where this SPV will engage with some credit rating agency. Okay. Now, the function of this credit rating agency is to actually see the quality of those mortgage loans, right? Is to actually see that the underlying is having how much value, what is the repayment capability of the borrower, right? Because in this entire model, the repayment capability of borrower is very critical. If that is not there, then either originator will have to take up the loss, or investor has to take up the loss. Why I'm saying investor? Because this SPV will act, because this SPV is acting on behalf of the investors, correct? So anywhere the loss can come, for that the risk profile, the repayment capability of borrower needs to be evaluated, which will be done by the credit rating agency. So they will also be evaluating that if the mortgage value is, let's say, covering up the entire loan value or not, or let's say it is falling down, whatever the case may be. Then what will happen is that in a regular basis, whatever EMIs these borrowers will pay, I'm saying in the form of repayment plus interest payments, whatever these borrowers are going to pay, these are these that they are going to pay is not to the bank, or let's say originator, or to the SPV. For that, there is a third party which will be appointed, receiving and paying agents. Okay. So they are also basically appointed by, let's say, originator and SPV collectively, and their responsibility is to collect the amount and pay it to the SPV. So they will be collecting the amount here and paying it to the SPV. Okay. So again, this is a secondary party to the securitization process. This is also a secondary party to the securitization process, right? The previous ones that we discussed are the primary parties to the securitization process, basically. So the role of this receiving and paying agent is clear. Clear? So the purpose of this receiving and paying agent is to collect the amounts on time, even follow up with the borrowers that these amounts are due now, and hence to pay it back to the SPVs by whatever that ratio has been decided between originator and SPV. The amount will be given. Okay. Now, if let's say the credit rating is good, now tell me one thing. If credit rating is good, and the second situation, if credit rating is bad, then what will happen to the return expected by investor? So can anyone tell me, if the credit rating is good, what is the return expected by the investor? Whether investor will expect a higher return or a lower return will also be okay with the investor. Nisha, okay. Hemant, yes. No, Nisha, okay. I think Abhikeji, you're right. Hemant, you're right. Nisha, okay, I'll explain you. So if credit rating is good, the risk is low. Risk is not high, risk is low. The moment risk is low, the return will also be, expectation is lower. Right? The return that can also be expected is lower. Clear? Because the credit rating is good, the repayment capability is good. Tomorrow, the probability of default is very low. Okay, Nisha, you were saying for the other one, yes, then it is fine. For this, the risk is high, and hence the return expected will also be very high. Okay, clear? So, can I say that the if the credit rating is good, the securities can be sold to the investors at a lower return? The answer is yes. If the credit rating is bad, the investors will expect a higher return on these securities. Clear? Let me check the other query handle also in case nothing is there. Yeah. Yes, it can be a combination also, Hemant. You're right. Yeah. Clear? Now let's move ahead. Are there any other questions, any other open questions that you want me to answer, students? Please feel free. Otherwise, let's move ahead to the second part of the discussion. So, okay,
Sir,
let
if
me
the
have a
rating is,
quick recap.
sir, I have a question.
Yes. Please go ahead.
Yes, sir, if the rating is bad, then there will be no safety to the investor of his principal amount.
No, I'll tell you. See, what has happened in practical life also, we have seen that if the credit rating is bad, then definitely there is no security left to the investor to invest. But here, there is a concept of insurance. Even in securitization, there are specific companies who deal with the insurance of such securities. Okay. For example, I'll tell you from the US crisis. Okay, there were these insurance companies also who will ensure that tomorrow, if these bad credit rated uh, bad credit rated securities go for a default, then such insurance companies will make up the amount good to the investors. Okay.
Okay, sir.
So, yeah, sorry.
Yes, clear, sir.
Clear? Yeah. So ultimately, what has happened in the US recession, I would, because this point has come. So what was happening there is, for a property of, let's say, 10 crore, okay, the banks have started given loan aggressively. Okay. Now, ultimately, what was happening, because of the very high demand, the real rate of the property remained at 10 crore only, but since the loan was being circulated in this entire chain of securitization at a very high pace, so the even on this 10 crore property, the loan that was disbursed was up to 100 crore for the same property of 10 crore. Okay. Now, what was happening? The real value of the property is 10 crore, but the borrower were taking loan, and even the originator was also giving loan, and then originator was getting it transferred to SPV was issuing securities to the investors, who were again the regular investors, as we understand from the above understanding, right? So the entire inflated amount came into this cycle, but the underlying value was only 10% of the inflated value. The moment one default triggered with this borrower, right, all the participants in the securitization collapsed. The insurance company collapsed because the huge amount of claims came over there. The originator, SPV, and investors were the first line of parties who collapsed again, right? So this can turn to a overall negative situation as well. Hence, the importance of these credit rating agencies becomes very much being there. No, I'll tell you, because what was happening. See, let's say today, so Hemant is asking that why it was inflated. Let me tell you. See, this borrower was in a need of funds, right? Now, today, the best way to get a loan from the bank is on the home loan, even if, let's say, the people would not want to use for the home loan purposes, right? Because it is available at a very cheap rate. You can mortgage your home and get the funds. Now, if they are in need of the higher funds, what will happen is, they will demonstrate to the bank that the value of this property has now become 50 crore, 70 crore. By that, they will get the money, right? And by getting the money on a higher level, they will, now this bank is having a higher exposure, but this has also given exposure to the SPV, and SPV has done its own work, but the credit rating agencies were also not doing their right work by determining the correct value. Had these credit rating agencies flagged off that the real underlying value of the mortgage is only 10 crore, how can you give a loan on that 10 crore up to 50 or 70 crore? That's where the problem is, right? I hope you understood now, Hemant, right? So this entire thing led to the economic crisis of US back in 2008. Because the moment these SPVs or originators had gone to sell the asset, which is the house, they only realized 10 crore. But their books were showing 100 crores of receivables, which they were not able to make it up, right? Yeah, so let's come to the second part of the discussion, which is the securitization instruments. Okay. Yes, Nisha has mentioned subprime crisis. Yes, that was called as subprime lending. Subprime lending means you are having those mortgage backed securities which are low on credit quality, which are subprime in nature. Okay, very good. Yeah, let's come back to the securitization instruments. Now, if you see, let's focus on this part where we said that SPV is issuing instruments to investors. Let's focus on this part, students. While we said that SPV is issuing instruments to investors, these instruments can be of three types. One is pass through certificates. Okay. Then second is pay through securities. And the third one is stripped securities. We will explain in detail, we will understand in detail what are the different kinds of instruments really mean. This we call as PTC, PTS, pay through securities, and these are called as stripped securities, SS, we can say. Okay. Now I have one question to all of you, which I want all of you to answer. So if I mention about security here, let's say I'm just putting different types of security, you can tell me what is the underlying. Okay. So if I talk about debt kind of a security, what is the underlying? Yes, mortgage assets in case that debt is a home loan. Hemant, you're right. In case if it is a home loan, mortgage assets will be the underlying. But in a common parlance, I would say for an underlying debt, the even the floating charges, yes. I am saying, let's say the interest rates. In case if it is a foreign lending, then forex rates will also be there, right? Clear? So these are the underlying. For equity instrument, can anyone tell me what is the underlying? If I talk about a equity share capital, what is the underlying for that equity share capital? By underlying, I mean from where it derives its value, right? Underlying is really, going behind that instrument and see that what is driving the value of that instrument. That is what I meant by underlying. Anybody want to attempt this? What is really the meaning of underlying? Very good. I think I'm getting some responses. Wait. Monica Jain is saying EPS. Okay, good attempt. Nisha is saying net assets. Yes. Hemant, dividend and capital appreciation. Sumit Jain, net assets. Abrikesh market cap. Karthik Gupta, dividend and market price. Oja Jin is saying dividend. Yes. Very good. I think all of you have attempted in a very right and fair manner. Now, equity has an underlying as its business. So I think all of you are in between, let's say from business to equity value, in between what all parameters are there. For example, dividend, for example, EPS. All of you have rightly mentioned that, but I'm just going one level further below where I'm saying the business of the company really drives its EPS. The business of the company really drives its dividend, and hence it drives the equity value. Clear? I have just gone one step below. But I really appreciate all of your responses. Now, these are the underlyings, right? Now, for equity, we have seen that it is not necessary that the whatever company has earned will be paid as dividend, right? Sometimes the company will keep certain amount in their funds, right, without paying as dividend. They can keep that, they will invest that. Then in the next year, if they want to pay dividend higher than what they have earned in terms of the cash flow, they can do that, right? So in equity, there is a clear delinkage between the earnings and dividend, right? These two are very much separate. Now, today a company may decide not to pay anything, right? So what I'm trying to say is that on equity, there are no fixed commitments that the company has to pay, right? Let's talk about mutual funds. Mutual fund students, come on, tell me. Mutual funds, yes, very good. Net assets, NAV. Nisha is saying NAV. So they have NAV, which in turn is derived by other companies' equity or debt, which is again will link to the first or second point, right? If it is a equity or debt, then again the first or second point. Very good, Sumit. It's net assets. But the distinction between a equity share capital and mutual funds is that mutual funds operates in a NAV model where whatever is being earned is being passed on as is, right? It just reflects in the net asset value of the mutual fund, and the investor is benefited out of it, right? Okay. And whether it will have a fixed commitment or not, it will depend on the kind of the mutual fund scheme that we operate in, right? Fourth, derivatives. So derivatives is also kind of securities. No, Hemant, I'm not saying mutual funds have. See, mutual funds are not related to securitization, but I'm just trying to draw the holistic, concept here, so that all of you are clear that how this might impact. Okay, it's not relevant to the securitization. Now, derivatives, the underlying, we are going to study in the next sessions. Okay, I will keep it for the next sessions, because this derivatives can have lot of other underlyings, right? Then finally, MBS, ABS, what will they have the underlying is the respective loans, right? Whether it is a mortgage loan, or it is receivable, or it is anything else, correct? These are the underlyings. Yes, Stephen, we will come to Bitcoin discussion later on in this chapter itself. Okay. Yes, so these are the different underlyings. Now, if you see, there are two ways to distribute a return, okay, which you will find across any kind of a security, which are actually elaboratively discussed in this first and second point. So the two ways of distributing a return is discussed either in the first or in the second part. So let's do one thing, students. Let's take a break of 10 minutes, right? And then again, let us reconvene back at 8:34. Okay. And let's discuss the balance topics over there. Welcome back. So let's take our discussion ahead on the pass-through certificates and pay-through securities. What is the different functionality of both of kind? Yes. So let's start our discussion on pass-through certificates. So we will try to explain it through some of the scenarios, right? Let's take a first scenario where borrower and SPV and there is an investor, right? These three parties are there. So the borrower is paying to SPV 100 on account of principal and 50 on account of interest, right? And 150 it is doing a prepayment also. So in totality, how much this borrower is giving to SPV is 300 rupees. 100 for principal as due, 50 for interest as due, and 150 it is prepaying to the SPV. Clear? And by I mean that there is a originator in between, okay, which we don't need to forget. So there is a originator in between, which is fine. But as of now, since we have to understand the other concept, hence I'm saying let's say the borrower is paying to SPV. And this SPV ultimately is getting how much amount as 300 rupees, correct? In totality. Now this SPV is also proportionately paying to the investor 300 only. So imagine a situation where this SPV is just acting as a pass through. By pass through, it means that whatever comes, it goes. Whatever comes, it again goes. For example, 300 rupees came, then 300 rupees has proportionately been distributed by the SPV. So this is called as passing through, right? This SPV is just acting as a pass through of the funds, right? But you will say that in all situations, SPV will act as a pass through. The answer is no. We will come to the other situations later on, right? So if this is the scenario, this is called as pass through certificate because the SPV has issued to investors pass through certificates PTC. Okay. So this means that whatever comes to SPV will be passed through to investors. Now let's take a second situation in this only, right? So here let's assume that the borrower, SPV, and then finally investor. So this borrower is now paying to SPV 100 rupees of principal as due and 50 rupees of interest as due. In totality, SPV got a cash flow of 150. Now this SPV is further proportionately distributing 150 rupees to investors. Clear? So SPV is not, again, SPV is acting only as a pass through. It's not having any decision making to retain the amount or to borrow the amount on its own, right? So SPV is just paying what it is receiving. Now, let's take a third situation where this borrower has made a rupees 80 default in payment. So let's say 80 rupees was due from a borrower to SPV, but there is a default that has happened. Now, how much SPV will give to the investor is the question. Would anyone would want to answer? So there is a default that has happened at a borrower level to SPV. Now, how much should SPV will give to the investor? Please remember, we are talking about the pass through. We are talking about pass through. Whatever SPV is receiving, it is passing through. Okay, Abrikesh ji, thank you for responding. Are there any other responses that anyone would want to share? I will come to the solution later on, but I just want all of your thoughts.
Sandil,
Yes. Yeah, Sumit.
so nothing has to be paid because it is a default.
Please think through whatever SPV is getting, it is passing through. Yeah, I will now explain in this situation what will happen. Yeah. So if you see the above two cases where the prepayment has happened, the SPV has given the entire amount. In the second case, not pay anything. Again, it will pass through the default to investors. So the investors will lose 80 rupees in the entire fund. So the value of the securities will go down by 80 rupees and nothing will be paid to the investors. Clear? So can I say that for investors, pass-through certificates we are talking about, right? Under pass-through certificates for investors, proportionate share in cash flows of SPV. So can I say that cash flow of investor would be linked to cash flows of the mortgage loan held by SPV. There is a clear linkage between what an investor will get vis-a-vis what that mortgage loan is giving to the SPV. Clear? So pass through certificates is done. Now let's come to pay through securities. So this is the second part. So this pay through securities, again, let's try to understand from the three different situations that we discussed in the pass through certificates also, right? So pay through securities is also called as PTS. So let's take case one where borrower, SPV and investor. Okay. Now the borrower is giving to the SPV as, let's say, 100 of principal, 50 of interest and 150 of prepayment. So the SPV will receive 300 in totality. However, while issuing the securities to investors, SPV has agreed or committed to a minimum, or let's say has agreed to a fixed payout of rupees 200 irrespective of whatever happens. So this is a feature of pay through securities, right? Pay through securities means that we are paying separately through securities. What? We are paying 200 rupees in fixed. So SPV will end up paying rupees 200 to investors. Now, if you see at SPV level, 300 is received, 200 is paid, 100 will remain here. Now, what will this 100 rupees be done by the SPV? Anyone would want to answer? So, SPV has received 300 in totality. The SPV has to pay only 200, which is fixed. Yes,
Further, it will be invested.
yes, Sumit. Yes, it will be invested. Perfect. Thanks for all who is answering. Pooja, Ginny, yes, it will be invested in the market. Yes, simply we will invest it. Now let's take case two. Borrower is there, then SPV is there, then investor. In this case, 100 principal plus 50 interest is being paid to the SPV. SPV will pay how much to the investor? Again, tell me. SPV will pay how much? Very good, Abrkeshji, 200. 200 will be paid to the investors. So, how much will be the shortfall here? 50 rupees shortfall. So, this 50 rupees shortfall will be taken from the earlier investment that we did. Earlier investment to be utilized for such shortfall. Clear, students? Now, let's take a third case also. There is a borrower. SPV and investor. Right? So there is a 100 rupees default now that is there. Right? Borrower has not been able to pay 100 rupees which was due as per the mortgage terms and conditions. Mortgage loan terms and conditions. Now, in this case, how much SPV will pay to the investors? Yes. Yes, very good application. 200. Again, it will have to pay 200 because the cash outflow from SPV is fixed because of this pay through securities terminology. That's why. Now, here what will happen? 100 default is there, 200 has to be paid. So ultimately SPV will need entire 200 from somewhere, right, to be paid. So out of this 200, 50 earlier investment is there which can be used, and balance 150 the fresh borrowing can be taken. Clear?
Sir, it is like non-recourse factoring.
No, it can be both recourse or non-recourse. In this also, it can be both recourse or non-recourse because the recourse or non-recourse will really impact whether the hit is being taken by SPV or not. Here we are only talking about the cash flows, right? So the lower receipt of cash flow from borrower can be managed by borrowing from the outside. So what I'm saying, it can be both on recourse and non-recourse. Okay. Yes. Clear? Should we move ahead? Just a second. Yeah. So now what is happening in, yeah. So now what is happening in pay through securities is, pay through securities is actually desynchronizing the cash flows required to be paid to an investor vis-a-vis cash flows it is receiving from the borrower. So cash flows of the investor is not linked directly to the cash flow of mortgage loan held by SPV. Clear, students? And in this case, what we are saying is surplus can be invested. Shortfall can be borrowed. Both the things can happen, right? Either if we are left with a surplus, we can invest that. If there is a shortfall or there is a deficit, it can be borrowed to pay to the investors. Okay, thank you, Ojajani. Now, can I also conclude that for PTS, pay through securities, it is having a separate identity of the from that of a mortgage loan, right? Because it has a separate identity. It is independent of the whatever cash flows that mortgage loan is having. Separate identity from that of mortgage loan, and pass through certificates is having a same identity as that of mortgage loans. So students, why we are using mortgage loans? Because generally securitization is done for the mortgage loans, right? I mean, the majority chunk is mortgage loans, hence we are using mortgage loans under this part. Okay. Now, are there some benefits or disadvantages when we compare PTC and PTS? Yes, there are some comparisons that we can do. Okay, just before that, let me tell you, for pay through securities, there is a complete desynchronization between what and what? Cash flow paid to the investors, cash flows to be paid to investors, and cash flows to be received from assets. Clear? So this is what we're talking about. There is a complete desynchronization between both of them. Now, finally, between PTS and PTC, let's compare certain good or so let's say certain advantageous and disadvantageous points. So this pay through certificate, pass through certificates, PTC. Now prepayment will also mean prepayment for the investors, right? So there is no stability kind of a cash flow that they will get, right? In the times of higher prepayments, they will get higher prepayments to them. In the case of lower prepayments, they will get nothing. So there will be spikes. So can I say that there is no stability in cash flows, and hence we can expect some of the spikes in pass through certificates? But in case of pay through securities, these are having fixed cash flows tenure, and hence the investor can expect cash flows to be coming on a fixed basis, right? So can I say that it's a stable cash flow security compared to PTC, right? And in this case, there will be no spikes in the cash flow. Now, if there is suddenly a spike, the problem in hand with the investor will be that where to invest the huge amount of prepayment received, or where to borrow in case there are some fixed commitments of the investors also, right? So investors who expects PTC, or let's say who are comfortable with PTC, will go ahead with PTC, otherwise they will go ahead with the pay through security, which is PTS. Is the understanding clear, students, till now between PTC and PTS?
Sir, Brakesh. Hello.
Yes, Abrikeji, you have some question?
Yes, sir. Sir, in case of PTS, why prepayment is not there? Is a system is such that no prepayment will be there?
Yes. Because in case of PTS, which is pay through securities, if the prepayment happens, right, then the entire essence of agreeing to a separate cash flow with the investor will go for a toss, right? Because in this case, the security itself is acting as an independent instrument to pay cash flows to the investor on an independent basis without linking it directly with whatever that SPV is receiving from the borrower. Clear?
Okay, thank you, sir.
Yeah. Perfect. Now let's come to the stripped securities, which is an easier one. So till now, we would have understood that any loan will have only two different cash flow strips, right? One is interest and second is principal. So let's say 100 is principal and 50 is interest. So I'm just drawing a line over here. Okay. So let's say this entire cash flow of 150 is split into two parts, 50 of interest and 100 of principal. Now, stripped securities will mean that we are splitting both the securities by their nature. One is basis the principal and one is basis the interest. So this will be called as principal only security, which we call as PO, and this will be called as interest only security, which will be called as IO, right? Now, if you remember our earlier discussion where we said that 1,000 securities at the rate 1 crore each will so I'm repeating it. I know there was a problem. So I was saying that there once we split the entire cash flow, 100 as principal and 50 as interest, there will be two kind of securities. One is principal only and second one is interest only. Now, in our previous case study that we were discussing, 1,000 securities into 1 crore each is what we discussed. So here also principal only and interest only can be split, right? Now, interest only will carry only the interest as the cash flow. Principal only will carry only the principal repayment as the cash flow. Clear? Now, let's try to understand the distinction between principal only and interest only in a detailed manner. One more thing, SPV is going to sell IO and PO separately in the market. Okay, now if let's say some investor wants to purchase a principal only stripped security, they can do that without actually getting the interest only stripped security. So principal only will be independent and IO will be independent. Right. Now let's take an example to understand in detail the impact of it. Let's say SPV has broken down into two type of securities, interest only and principal only. So this interest only is sold to investors and this principal only is also sold to another type of investors, right? We are saying here it is 100, here it is 50 rupees for the sake of example, right? And initially, the interest rate is at 10%, IO is 50, and principal only is 100. Clear? So at the time of this securitization, at the time of giving the loan, the interest rate that was prevailing was 10%. Now tomorrow, the market interest rate, which we called as yield, right? The bond yield. Let's say it increases to 12%. In case it increases to 12%, now can anyone tell me what will happen to the interest only and principal only security prices? Let's first talk about the interest only. So let's say I have purchased a security which is an interest only security, and the price that I've paid is 50 rupees, and I have got a commitment of payment of 10 rupees, 10%, right? It's a 10% equivalent value basis that 50 rupees is arrived. Now that 10% has increased to 12%. Now can anyone tell me what will be the value of interest only and principal only? Let's first talk about interest only. Okay, let's first say whether it will increase or decrease. What do you think? If the interest rate has increased from 10 to 12, whether interest only will increase from 50 to up, or whether it will decrease from 50 to downwards? Can anyone attempt this question? Okay, Abhikesh ji, thanks for responding. Yes, Mamta. Okay, thank you. I'm not revealing the answer as of now. I'm just expecting. Okay, so let me take this up. So let's try to understand it through a very mathematical manner. Okay, so 50 rupees represents 10%, right? Okay, Nishat. Okay, thanks for the thoughts, all of you. Now, let's see here. 50 rupees represents 10%. So can I say that 50 by 10% will represent the entire amount, right? On which the interest only is calculated. On that, now the expectation will be 12%. Right? So this will become 50 by 10% into 12%. So in a way, it will become higher, which is 60 rupees, if I'm not wrong. Clear? I hope this is clear. Then let's talk about the principal only. Now, I think the bond valuation is done, right? The topic related to bond is already done. So from that, let me just borrow one concept here, which says the interest rate is inversely proportional to the bond prices. Correct? Where can I say that if the interest rate is higher, the bond prices will go down, or if the interest rate is lower, the bond prices goes up. Now here the same situation holds true for this principal only security also, because it is a kind of bond. I mean, assume it is a kind of bond, right? Because it is representing the principal value. So here 100 On that, we would have been multiplying 10%, but now that will change to 12%. So this will become 83 rupees. So it will go down and it will go up. So the implication is clear now, students. So the clear implication of increasing the interest rates on interest only security is that it will increase the value of the security for interest only, but for the principal only, it will decrease the value, because principal only, it will act as a inverse relationship. Okay, Sumit is asking, sir, why it is going up in the interest only security? Reason being, this 50 rupees of interest was representing 10%. Now, if the market rate will go up, so the investor will also expect 12%, right? So that will come from 50 divided by 10% would have been your basic amount on which you were getting 50 rupees, which was equivalent to 10% at the time of securitization. But now that expectation has revised to 12%. So ultimately, your interest only security will go up. Now let's take another situation where the market interest rate goes down. Okay, so the market interest rate is now actually, let's say, going down to 8%. So the initial was how much? 10%. Interest only initially was 50 rupees and principal only initially was 100 rupees. Correct? So now in this case, if the percentage goes down for IO, 50 rupees was representing 10%. Now with that 8%, the price of the interest only security will go down. Reason being, the initial amount of 50 rupees has been agreed on 10%, but now the expectation has gone down. So the interest only security will also go down. It will become 40 rupees. And for principal only, again, we will apply the same concept of interest rate is inversely proportional to the bond rate, right? And principal only is in the nature of bond because it's the principal amount. So if the interest rate goes down, the value of the principal security will go up. And mathematically, if we want to write 100 into 10% would have been the rate, but now divided by 8%, right? So this will become 125 rupees. Clear? I hope this is clear, students. Interest only and principal only. Yeah. Okay. So with this, the different types of certificates, the different type of securities is, that topic is over, right? Now let's take one or two examples to just brush up our understanding on the subject. So let me take an example of pass-through certificates, right? Now let's assume there are three different mortgages: principal, interest, and let's say I'm talking about maturity here. Okay. Now the securitization that is happening, let's say this is happening for three different mortgages. Mortgage one, which is having a principal of 100 crore. it is having an interest rate of 5% and maturity of 2 years. Okay, this is mortgage 1. Mortgage 2 is, let's say, 200 crores, and the interest rate agreed on this mortgage 2 is 5.5%, and this is, let's say, for 1 year. These are not practical examples. I'm just giving these examples just to tell you how the calculation happens at the SPV level. Okay. Then let's say there is another mortgage 3, again of 200 crores, and the interest rate is 6%, and this is for again 1 year maturity. Clear, students? So these are 3 different mortgages, and these 3 different mortgages are presented to an SPV for securitization. So SPV will, what it will do? SPV will raise 500 crores, right? SPV will raise 500 crore from investors, because it is going to issue the mortgage backed securities equivalent to this 500 crores, right? Now, what will I say to the investors? The weighted average mortgage rate will be how much? The percentage I'm talking about, it will be 100 divided by 500 into 5%, correct? The first one, 100 crores divided by 500, which is the total of this, into 5%, correct? Similarly, 200 divided by 500 into 5.5%, the second mortgage, and the third mortgage is also 200 divided by 500 into 6%. So the overall weighted average, if we solve this, it becomes 5.6%, right? Can I say that this will become the income of SPV? The answer is yes, because ultimately this is what the borrowers will give it to you as SPV, right? So this 5.6 percentage will be given to the SPV. Then let's say there is an operational margin of 0.6 percentage in this. Okay. So operational margin is what? Let's say their day-to-day expenses. So 0.6 percentage SPV will keep with itself, and balance 5% is available for distribution to investors. Correct? So this 5% is available for distribution, and we call this as a net pass-through rate, because this will eventually pass through from SPV to the investors, because we are talking about the pass-through certificates here, right? Then if I want to talk about the weighted average maturity of these mortgages, I will say 100 divided by 500 crore. For the first loan, it is 2 years. So it will be respective loan amounts and the respective years at weightages. This will be 1.2 years in totality, right? So then SPV will propose to investors return of 5% for 1.2 years. So this is how the, let's say, terms and conditions of this SPV will be there, and these will be finalized. Clear till now? Perfect. So now let me share the study material and let us go through the study material. After that, we will be only left with last topic, which is the tokenization, cryptocurrency, Bitcoin, whatever we want to say. That entire topic is clubbed into one that we will do in 15-20 minutes towards the end. But before that, let's go through the study material once, because securitization being the topic at a theoretical level, so I just want you to run through at the study material level alongside me so that we can discuss the same. Okay, just a second, let me share the screen on a study material. I hope the screen is visible. Yes. So, see, I'll just take you through the study material also, what all things we have covered today, right? Yeah, so I hope now the screen is visible, right, on the study material. Yes. So yeah, let's start. See, first of all, in the introduction, it has been given that why there was a need of securitization in India, because some of the companies were having huge receivables in the form of, let's say, any sort of receivables, right? In terms of mortgage loans, credit card receivables, automobile loans, and hence to provide for a solution on getting those illiquid assets into the marketable securities, the concept of securitization was evolved, right? Now, in case features of securitization, if we see the creation of financial instruments, now if you see these marketable securities are financial instruments, right? Because they promise the holder of such securities that they will be repaid amount once the amount is there. For example, in pass through and PTS we have studied, right? PTC and PTS we have studied that how the cash flows goes to the investors. Then bundling and unbundling. What we say is that first of all, the pooling of the funds is called as bundling at originator level, where originator is bundling all the illiquid assets, and unbundling is finally happening at the SPV level, where the SPV is actually putting it into the different securities and selling it to the investors. Then it acts as a tool of risk management, because in case, let's say, the non-recourse basis is adopted by the SPV, then the risk of not being recovered and hence being there is so basically is not there with the originator, right? So originator is absolved from all the risks that it can come. Then it is a part of structured finance, right? Because so let me explain how structured finance works. For example, as I said, that SPV will be issuing different types of securities, right? Now, while issuing those securities, SPV will also go through that what are the terms and conditions of those. So, for example, let's say there is a mortgage which is a high return mortgage, right? That will be issued as a single tranche. The another mortgage is a low return mortgage that will be issued as a second tranche. So it structures your securities in line to what the mortgage is. Then trenching is something related to the tranches that I have just now discussed, right? That different tranches comes from the different features of the mortgages. Homogeneity, why we are saying homogeneity is because within one tranche, everything will be homogeneous. Now, if I can tell you that, okay, structured finance, trenching, and homogeneity is basically you all of you know that there are different classes of equity instruments, right? For example, there will be class A, class B, class C. The dividend rate might differ. The terms and conditions attached to such might differ. Even let's say preference shares in other is another class of shares, right? So for preference shares also there is a securities. Hello. Yeah. So what I was saying is, just like shares have different classes, similarly, these securities also have different classes depending on the different type of yeah. So in terms of the benefits of securitization, let's first understand from the angle of originator. So originator is having this item as a off balance sheet financing because the finance never comes, the debt or equity never comes to the balance sheet, right? And it will help in driving more specialized business. Let's say for banks, it will make available more funds which can again it can lend. Then also it will help in the financial ratios because the debt equity ratio will not go up as we discussed, right? And hence it will also help in reduced borrowing costs because the borrowing will not come and sit into your balance sheet, right? These are the benefits to the originator. Now from the angle of investor, the person who has invested, there is a proper diversification of risk because not only you are investing, but you are investing with a lot of other individuals, with a lot of other investors, and these are backed up by the different classes of the assets, right? Then there is a proper regulatory requirement. Now let's say today you want to acquire certain set of receivables. You need not necessarily invest 100% of the amount, but you can take smaller securities and still be present in that environment, right? Then finally there is a protection against default. As I was mentioning, even in case of recourse arrangement there is a protection, but there are certain insurance covers that will provide you against protection against the default, right? Then who are the participants in securitization process that we discussed? There are primary participants. Who are they? Originator, which was the bank, right? Who has given the loan and the loan is standing in the books of the bank. Then special purpose vehicle was created specifically for the purpose of acquiring these loans, right? And issuing the securities to the investors. So if you see the last line, further, it also issues securities called asset-backed securities or mortgage-based securities to the investors. ABS, MBS based, right? So the same thing that we discussed. Now, if you want to really understand what is ABS, MBS, please refer to our initial discussion where we discussed what was that. The investors are the ones who are buying such securities, right? Now let's come to the secondary participants. As we discussed, right? Secondary participants are okay. So first of all are obligers. So the obligers are the borrowers, right? So these people are the similar ones who are the borrowers. So they are the main root of the whole securitization process, right? Because they have borrowed, hence they form the basis of the entire securitization process. Then similarly, rating agency. As we discussed, the function of rating agency is to enhance, or let's say is to comment upon the adequacy of the quality of the instruments that the SPV is issuing by checking the underlying mortgages, right? Then there are receiving and paying agents that also we discussed. So their primary responsibility is to collect the funds and to pay it to the SPVs, right? And to manage the entire book, to manage the entire administration of the funds, to act as a service provider. Then agent or trustee. So this part also we discussed, right? We mentioned who are trustees. So these trustees are generally appointed to the board of the SPVs because these SPVs are formed in the form of trust, right? Then finally there is a term called credit enhancer also. Now this credit enhancers are generally those who will do the credit enhancement of the securities issued to the investors. So these are nothing but the insurers. So credit enhancer means that I am giving a surety that tomorrow if the SPV is not able to pay to the investors, then I will make the default good. So I will be called as the credit enhancer in that case. Then finally there is a structurer who will structure all these different parties at one place alongside the transactions. Students, clear till now? Please let me know. Then we discussed about the process or mechanism of the securitization, where we said that it starts with first the creation of the pool of assets, where the originator will collect all those liquid assets at one place. Second is it will transfer to the SPVs, which we already discussed. Then SPV will do the securitized papers and it will sell those securitized papers. Then lastly, administration of the assets will also happen at receiving and paying agent level, right? As well as at the SPV level. Then in case there is a recourse to originator, it will happen once the default is made by any of the obliger or borrower. In that case, SPV will go back to the originator and ask for the recourse. Then repayment of funds. So SPV will pay the funds back to the investors in the form of interest and principal, right? And there is also a credit rating to the instruments that is happening, right? That's what we discussed. Then what are some of the problems in the securitization process? Yeah, so the first and the foremost is the stamp duty, because securities attract stamp duties as per the Transfer of Property Act, and hence this makes the securitization process a bit costlier because the stamp duty needs to be incurred. Then secondly, from the taxation point of view, there are different viewpoints that whether the receipts from the receipts to investor from SPV should be taxed in the hands of recipient or should be taxed in the hands of SPVs. No. Securitization papers and commercial papers are different. Abrikesh ji, commercial papers are the form of borrowing. Securitization papers are the these securities that we are issuing, right? These are called as securitized papers. Then finally, on the accounting bit, even accounting also poses a lot of challenges, right? It's very unclear and there is no standardization process in terms of the accounting part. Then inadequate debt market. So if there is no well developed debt market, then definitely instruments like securitization have lower chances to succeed. And lastly, in case a mortgage holder, a mortgage loan, or let's say a borrower or a obliger is doing a foreclose. Okay, let me ask you, what do you mean by foreclose? Does anybody know what do we mean by foreclosure?
Before the maturity of time.
Yes, Abrikeji, that is correct. So basically, foreclosure means that before maturity, if some obliger is repaying the amount, that is called as foreclosure. Now, effectively, what we have seen, there are no proper foreclosure laws, whether there will be any penalty, whether there should be any penalty. So this is not very explicitly there in the Indian context, and hence these are some of the issues or let's say problems in securitization that is there, because the moment you do foreclose, the second cycle of SPV to investor will also get triggered, right? Then securitization instruments, all of us, we have discussed about it, right? One is pass through certificates, which is PTC. Then second is the pay through securities, which is PTS. So you will find each and everything that we have discussed is already part of the study material. See that if I read the third para of PTS, it says that, in other words, this structure permits desynchronization of servicing of securities issued from cash flows generating from the asset. The same thing, that's what we discussed, right? Then stripped securities, we discussed about the interest only securities and principal only securities. Very similar, right? And in this also, if you read the para first, second, third, fourth, fifth. So fourth and fifth, in case yield to maturity market rises, PO prices, which is principal only prices, tends to fall. The same thing, right? As borrower prefers to postpone the payment on cheaper loans. So similarly, the next para, in contrast, value of the IO security increases when the interest rate goes up. The same example that we discussed, right? 10% going up to 12%. I hope you are able to relate it to what we have studied. Yeah. Then the pricing also a small part we discussed, right? From originator's angle and from investor's angle. See, ultimately, originator will be able to price it at the rate at which it has to incur an outflow, right? And investor will, what investor will do? Investor will take the future cash flows that are coming into account, take a present value it, and according to the investor, that should be the right value, right? So from both the angles, there will be differences in the form they will expect the pricing to happen for these securitized instruments. Then what are some of the risks in securitization? See, first of all, there is a big amount of credit risk or counterparty risk. So credit risk is the non-performance, or let's say the bankruptcy of the person who is required to repay the amounts. That is the credit risk. Legal risk, now again, as we said, that in the absence of a well defined regulatory framework, there can be legal risks attached to it, where the absence of law can create some of the issues. Market risks, now market risks are generally driven from the market angle. Now there are certain macroeconomic factors which will lead to the adverse movements or which can lead to the favorable movements, right? Which is again beyond the control of investor as well as SPV, right? So such macroeconomic factors will lead to certain issues under the under the belt, right? Now, prepayment risk are those risks, as I was discussing, that in case of pass-through certificates, if the amounts gets prepaid, then it becomes really difficult for the investor to invest that amount back at a higher rate. So the prepayment risk is the prepayment happening, but the investor is not having the required rate of return available in the market to reinvest that. It is also, I mean, it is linked to the reinvestment risk, right? Then finally the interest rate risk, because the interest rate can go up and down depending on the policies of RBI as well as the market forces. It will also lead to the securitization. It will also lead to one of the risk in the securitization. Now this is a new topic on this tokenization, or we can understand blockchain first and then we will move to the tokenization part. Okay. So hear me out. This is something that is very different. This is a very different concept of blockchain. Okay. So if we understand right, blockchain is comprised of two words. One is block and second one is chain. Now, what is a block? A block is it can be anything, right? But that block contains certain pieces of information, right? So I'm just trying to make a block. So let's say this is block 1. Similarly, there will be another block. So this is block 2. Okay. So there can be n number of blocks. And what does these blocks have? These blocks have certain pieces of information. We will come to it, what exactly pieces of information these blocks will have. And these blocks are connected through chain. So similarly, block 2 will be connected. I'm just making a square only here. Block 3. Then similarly, block 4. Then similarly, block 5. And so on, right? So this technology of putting some information in a block and connecting it to a chain and making it a relay is called as a blockchain technology. Now, what happens that there is a network. Yeah. So I'm saying that there is a network. So let's say this is a complete network. In this network, there are millions and millions of users. Okay. There are millions of users. Now, what happens? All these millions of users will have access to this entire chain of blocks. Chain of blocks will be accessible to users. So all of them can see this and all of them can keep on adding more blocks at the same time to this chain, right? So it's called as distributed ledger technology, DLT. So just to make you understand, let's say there is a Google spreadsheet. On that Google spreadsheet, multiple users can update the data at the same time, right? Without letting any other user to first save my data and then another user can work, right? It's not like that. all the users simultaneously can update the data. That is why it is called as open editable workbook, right? So similarly, the entire chain of blocks is available with all the millions of users. Any one of them can go and read what is mentioned in the block. Any one of them can go and add a block to that existing chain and keep on adding the other. And whenever any user adds a new block, all the other users are able to view the added block. Okay. Now, what it will happen, it will create a repository of resources and it will help in executing some of the transactions. Now, the processes, I'll tell you. Let's say Mr. A has to pay 100 US dollar, or let's say I am saying Indian company has to pay 100 US dollar to a Australian company, for example. Right? So currently what happens? This is a current scenario. Indian company, Australian company, $100. So this Indian company will contact a bank in India, right? And Indian company will instruct the bank in India to pay $100 to the account of this Australian company. Now, what this bank in India will do? It will have its own US branch, or it will have some intermediary in the US, because this is a US dollar. So US bank. So whatever this Indian bank is having its account with the US bank, it will ask to transfer this $100 from this bank account to Australian's bank account, right? So let's say this is a bank in Australia, and this is also having an account with this US bank, and Indian bank is also having an account with this US bank. So this $100 on the instruction of this bank, basis what this Indian company has said, will get transferred from this bank to this bank, and finally the bank in Australia will give a confirmation back to A that the amount of $100 is received. Correct? This is what we call as Swift process, right? Correct? So the amount is routed through US because we are talking about the US dollar as a currency. Clear? Now here what will happen under blockchain technology? Clear, students, till now? Should we go ahead? Yes, perfect. So now this block, first of all, whatever gets added will be visible to everyone. Now in this block, let's say Indian company creates this block and it says that India is paying to Australia $100, and after payment, India is left with, let's say, $10, and Australia is having $200. So this is the balance after the above transaction. So this block will record what? This transaction as well as this balance. Okay, and this will be visible to Australia, India, and even other users who are there on this network. Right? This will be visible to all. Clear? Now, if Australia is okay with this block, it will allow transaction will come. Accordingly, it can be added. So what I was saying is that these blocks will be hosted onto the network. The Australia and the other users will actually validate this block, and once validated, this will get added, and then subsequent blocks will also get added to the same. So by this, the actual movement of money
Okay, sir.
has not happened,
Devas sir.
but the yes, sir.
Devas,
Yes, sir.
Devas sir, just explain 2 or 3 minutes before because your voice stopped at this moment.
Sure, sir.
Again,
Sure,
just
sir. Sure, sir.
because
Sure,
when
sir.
you
Yes, sir.
told about na, this is first you this is when you have raised the draw this line.
Yes, sir. Yes, sir. Sure.
Okay, just
I will repeat, sir. Yes, yes.
just
So yeah. So what I was saying is, yeah, okay. Let me say that Indian. So in this block, so this current block has represented two things. One is the transaction, where it is mentioned that the Indian company is paying to the Australian company $100, and after that payment, what is the balance with India and Australia? Let's say India is holding $10 and Australia is holding $200. So this is the block. Once this block is created by the Indian company, this will be validated by the Australia counterpart. And once validated, it will be added to this block, added to this chain that is coming previously, right? So this block will get added, and later on, other blocks can be added subsequently. So it will form part of that chain, right? So this is essentially the blockchain concept, right? Where the different blocks can be added to the chain. Now, what happens? There are actually data miners whose responsibility will be to check the information that is put into a block and decode it and validate it so that it can be added to the block. So these are the technical people. Then there will be end users who will be doing the actual transaction in this, right? So this is the concept of blockchain, students. Now, in case if there is any doubt, we can discuss that. Otherwise, let's move ahead to the tokenization.
Sir, in blockchain, the transaction is verified simultaneously.
Yes, it is verified simultaneously. So let's Sumit. So private post the data. Hope I can be heard. Am I audible, right?
there is some voice issue again. Just explain.
Yes, yes, yes. It is audible now, sir. Yes.
It is audible now.
Yeah, yeah. So what I was saying that the Indian company will host using its public key, and the Australian company will validate using its private key. So yes, there is a proper process of validation. And let me tell you, no one can change the data that has been entered in the previous block. In case you want to change any data in the previous block, another block is created and added to the previous block. Then only the data can be, and it has to be read in the previous block sense. Okay, so the
Devas sir. Devas sir. Yes. Devas sir.
yes, sir. Yes, sir. There is some.
I think you do, just switch off your camera for 5 to 10 minutes.
Sure, sir. Sure, sir.
It
Sure,
will
sir.
help. Okay, because I
Yes,
think
sir.
there is some net issue.
That issue at my end. Yes, sir. Yes, sir.
Yeah. So just
Sure, sir. Sure. Yes. So yeah. So what I was saying is, yes, it is validated at a real-time basis, and hence the transaction is added to the blockchain. Okay. Now let's come to the concept of Yes, student. So let's come to the concept of tokenization. Tokenization
Devas sir? Sir? Devas sir? Devas sir?
Yes, sir. Can I be heard now?
Sir, just take a break of 2 minutes and restart your system.
Okay, okay, okay. Sure, sure, sure.
It will be better.
Sure, sure. Okay, okay.
अशोक जी 2 मिनट का ब्रेक लगा दीजिए. Student, please join.
After the break. Only there's a small break.
Just 2 minutes break.
Value, for example, some of the artistic paintings, some of the musical creations into again a token which will be hosted into the blockchain technology for sale or purchase, using which the again the illiquid some kind of a illiquid asset will get converted into a marketable or transferable securities. So that is called as a tokenization process. So if I may go back, So if we see under tokenization, we first refer to understanding the blockchain, which we discussed, right? Which is the distributed ledger technology, in which we said that the same ledger is shared with multiple users across, and they will be simultaneously viewing and updating the databases. And it's very much similar to the Google document where multiple users can update at single go. We also discussed about the steps of how blockchain works. For example, a transaction like sending money is initiated where we understood creation of that block has happened. Then the transaction is broadcasted via the network where we said that the block will be given up on the network. Then the network is also validating this transaction using cryptography. This cryptography is again series of algorithms which are written by the experts which validates that. Then finally, once the block is validated, it is entered as a block. I mean, the transaction is entered as a block and it is added to the existing chain, and hence the transaction is complete, right? Then these are the some of the useful applications of the blockchain. The first one being financial services, where we say that the blockchain can be used to do the transaction logging of some of the transactions. For example, of any asset or property, it needs to be kept for any detailed manner, whether it is in a physical form or a digital form. Then healthcare, whatever healthcare records for a specific patient or for a specific hospital needs to be kept, it can be kept using the blockchain methodology where the doctors can have access to it, right, simultaneously, and they can also change the records. Similarly, from the government level, in case they want to have the registration data of a property, they have to maintain a chain of documents. They can use that. Similarly, in the travel industry, if let's say the records has to be kept for travel insurance, and then passports and other related documents, that can be done. And similarly, economic forecasts also, wherein the different forecasts on the economic as well as the financial front can be put it, and accordingly blockchain can be created, right? Then in terms of the certain risks that are associated with the blockchain, now there are different members that are available who can edit the blockchain, right? So there is a risk attached to it. There are different risk appetite and tolerances of those members, right, which can be very different from what your organization could have, right? Then as we all know that there are very less regulatory interventions, or in terms of there is very the law is not very much evolved in terms of the blockchain as an entire environment. And finally, it has a very huge humongous amount of data. We really don't know where that data is actually being controlled from. So these are some of the risks. Now in terms of the tokenization, we discussed that tokenization, we convert the tangible and intangible assets into blockchain tokens, which can then be easily traded, and hence it becomes a marketable kind of a security, right? And the securitization and tokenization have some common features. For example, liquidity. It will enhance the liquidity, as we have been discussing, right? Diversification of risk, because now multiple investors will be investing, and again the risk will get diversified. Then finally, trading, in a way it helps to keep the cash flow going and helps in generating the wealth. Then finally, new opportunities for the financial institutions to come in and agree to do the entire process. So yeah, students, that was it from my end. So with this, I think we come to an end of the securitization topic. Yeah, so thanks a lot for all patience listening. Ashish
Sir,
sir,
I have a
you-
question.
Please.
Yes, sir. NFT is an
yeah,
example
yeah,
of
Sumit, yes.
tokenization.
Sorry,
Sir,
Sumit.
NFT is a, sir, NFT is an example of tokenization.
Non-fungible tokens, yes, you can say. NFT is an example of tokenization. Yeah.
Okay, thank you.
Any other question, students?
I think there are no more questions. Okay, student, with this, we come to the end of this topic of securitization. Now, Divas sir has very beautifully explained the basic concept of securitization, and very important, when we talk about the blockchain, the concept of cryptocurrency comes into our mind. But please, student, you now in today's class, you must be aware that now you have come to know that cryptocurrency, how it is created. But please remember, we don't never encourage to trade with the cryptocurrency, bitcoins, etc. So, but our purpose here to incorporate this topic of blockchain is to just to make aware how we can this technology can be used for the record maintenance, because I think some days in a newspaper this was in news that even some government authorities are trying to use the blockchain to validate the title deed of the property. So this is in the process. Of course, it will take some time because there are some issues like datas are uncontrollable. Like there are many issues because we have to check a lot of things. And similarly, if we talk about the tokenization, it is a very interesting concept, because if I want to buy an art piece, okay, but I don't have the money. So, but what I can do, if the art piece has been tokenized, so I can purchase one piece, because if in the art piece one piece is cut it out and given to me, then the art piece will not have an effect. But once through the tokenization, I have invested some money in some art piece. Okay, student. So it is a kind of an innovative financial concept that are taking place worldwide. Divas sir, thank you very much for your sparing your precious time. Of course, there are some technical glitch.
Yes, sir.
No problem. But you have explained this topic in a very beautiful manner. So, student, thank you very much for patient listening. Now, there is one thing in the coming two classes of the security analysis, you are requested to please check up the schedule, because there may be some possibility that the class may not take place. So my request to you, please, in today by today evening, we will update the status if it will be possible. Otherwise, the two classes will not be there. Then after that, mutual fund class will be there. Okay, student. Thanks for your patient listening, and see you in the next class. Thank you. Thank you, Divas sir.
Yeah, thank you, sir. Thank you. Thank you, everyone. Thank you.
Thank you, sir. Thank you, Manoj, Ashok ji.
Thank you. Thank you.